Good afternoon and welcome to our webinar today, What Boards Can Learn from the Failures of SVB and Signature Bank. I'm Emily McCormick. I'm the Vice President of Editorial and Research at Bank Director, where I oversee our research initiatives and content for the Bank Services Program. I also write for Bank Director Magazine and bankdirector.com. Now today we brought together a panel of governance experts, and we haven't convened to Monday morning quarterback the recent bank failures. We know there's a lot more information to come. I'm particularly interested in the report due out from the Federal Reserve's Vice Chair for Supervision, Michael Barr. That assessment's coming out May 1st. But what we're planning to do today is to understand the implications for the industry, and in particular, break down some lessons for bank boards that have come out of these recent disasters. Now, we're going to get all into this shortly, but I do need to review just a few housekeeping items first. First off, we can't hear you. You're in listen-only mode in this webinar. We do recommend to view this at its best, that you use the slide bar at the bottom of the screen. That's going to put the presenters into full screen mode. Now, as far as questions, we strongly encourage you to ask questions during this webinar. We would love to hear from you and tailor this discussion accordingly. So if you do choose to ask questions, that's pretty easy to do. There's a Q&A button found on the right-hand side of your screen. Just click it and ask away. And you can ask it any time during this webinar. We're not going to hold questions to the end. We're going to be taking Q&A throughout. I'll be trying to keep an eye on that during the conversation. Now, if you have any technical issues, we of course want to help you take care of those as well. There's a moderator chat feature that's also found on the right-hand side of your screen. If you click on that, just ask for help and we'll try our best to help. Don't worry about taking notes. The presentation will be shared with all attendees within 24 hours via email. You'll also be able to find the recording on bankdirector.com. And finally, the opinions expressed in this webinar are those of the individual speakers only and do not necessarily reflect the opinions of the other speakers or of the entities with which the speakers are associated. So with all those housekeeping items addressed, let me introduce our panel. First off, Charles Elson is the retired Edgar S. Willard Jr. Chair of Corporate Governance and the founding director of the John L. Weinberg Center for Corporate Governance at the University of Delaware. He's also a consultant to the law firm Holland & Knight and executive editor-at-large of directors and boards. Julie Stackhouse is the former executive vice president of supervision, community development, and learning innovation at the Federal Reserve Bank of St. Louis. Today, she serves on the board of directors at Simmons First National Corporation and Simmons Bank, based in Little Rock, Arkansas. I think particularly notable for this conversation, Julie is also the member of the audit and risk committees at that institution, so there's definitely going to be a lot to explore there. And last but not least, Jim McAlpin is a partner at Bryan Cave Leighton Paisner, and he's also a board member here at Bank Director who contributes to our certification program and our broader efforts to train and educate bank boards. So welcome everyone. Thanks for joining me today. Good to be here.
Very good with you.
Well, we're gonna dive right into this, but just one more quick reminder to our audience, please don't hesitate to ask questions throughout this discussion. We'll address Q&A throughout as we can. So let's dive right in. And I think there's a fascinating governance story here, which is why we're all together. So let's just start out. I just want to get your point of view on the biggest governance gaps that you believe that the collapses of SVB and Signature Bank have exposed. So Charles, maybe you could kick us off here.
Sure. I mean, look, we're really early in this, and it's going to be really hard to make any definitive comments one way or the other, because we just don't know what the board knew, what they were confronted with, et cetera, et cetera. I mean, on a preliminary level, Valley Bank was critiqued for not having a chief risk officer for 6 months. Now, is that something to think about? Yeah. Is it relevant? That's what we'll have to see. Had you had someone there, would they have picked up on this, and would a change have been made in time to resolve the situation? We'll never know. Or perhaps whoever was there served on an interim basis, but a committee that was following that, did they take the consideration? We don't know. You also have to remember this, at least their collapse, it was based on the purchase of long-term treasuries in 2020. When the interest rates went up, the treasuries became worth less, they had to market, and they had these losses. Was that their fault? Should they have only had 30-year treasuries? Well, life insurance companies do that all the time. That's because they have long-term policies to pay off. Banks are in a slightly different position. The question, though, is who's responsible? And a part of it, frankly, has to do, sadly, with the Fed. But it's not really the Fed's fault for raising rates. The fault was the inflation. Where did the inflation come from? And this was controversial, as y'all remember, 2-3 years ago, was the two big spending bills that some argue would be highly inflationary. Others said they weren't. In fact, they were. And here we are. So can you fault the bank board for not appropriately recognizing the risk of the greater interest rates? That's a tougher call. But we're going to have to see, what did they discuss in their meetings? Were they aware of it? Did they take the risk anyway? And that I think, to me, is what comes out of it. The other thing was a question of expertise on bank boards. I mean, traditionally, folks on bank boards way back were customers of the bank, basically. They were large customers, and that was the way to keep them in the stable. That's not the greatest recipe for a great board, because that's not their expertise. A bank board without any people who run big companies, is that a good idea? No, you need that, because obviously they are ultimate customers. The key has got to be a mix of people who have a real understanding of the bank and financial industry, and those who can offer different perspectives. And I think that's kind of the takeaway of this whole thing. And that would apply to Signature, sort of the same thing, though Barney Frank may argue that he was an expert. I don't know. We'll see when it all comes out. But I think that, to me, it's important not to rush into a conclusion. But those sort of basic rules are things that every bank should comport with: independence and some knowledge, either significant or at least some knowledge of the industry, contemporary industries themselves.
Yeah, I think there's a lot there that we're going to dive into a little further. Julie, Jim, is there anything you want to add on to that?
Emily, I'll add a few thoughts. Hopefully, everyone on this call receives the press releases from regulatory authorities. If you don't, do it. They're really important to getting insight into a number of things in the regulatory world. But not too long ago, the press release with Vice Chair Barr's testimony to the Senate Banking Committee was released. I think it was March 28th. And he was careful to not reach a conclusion too quickly, but he made a statement that really caught my attention. And that is that he noted that the bank supervisor issued 3 findings related to ineffective board oversight, risk management weaknesses, and the bank's internal audit function. Wow, those are like the big 3. So when I look at this and sort of think about, well, should the board have seen it? If there have been supervisory MRAs, matters requiring attention, or MRIAs, matters requiring immediate attention, I, as a board member, would put those at the top of my list at every board meeting to say what's going on here and what does it mean. I'd be worried about it because those things are not presented lightly by regulators.
Yeah, probably because I've spent 40 years representing banks and bank boards, but I'm reminded of the scene in Lawrence of Arabia where the Turkish fort is facing the sea and all the guns are facing the ocean, and Lawrence leads the army across the desert, and there are no guns, there are no cannons facing the desert because no one ever thought anyone would come across the desert. Well, I'm sure after that battle, the next time somebody built a fort, they had guns facing the desert. And, I look back to the Great Recession and all the banks that started failing in 08, 09. Yes, there were high CRE concentration levels, but no one was expecting the entire commercial real estate market to lock up because of things that happened on Wall Street, right? And I think this bank board, I think it's way too early to criticize anyone on that board. Yes, management bought treasuries, but, you know, it was a permissible investment. Can you think of anything more benign than a treasury? And who really thought interest rates were going to go up 5% a year? No one was thinking about that. And, you know, I'm reminded back, Emily, to Acquire or Be Acquired that it happened late January, early February of this year. We had 3,000 people there. We had some of the brightest investment bankers in the country, and they were talking about AOCI, and they were talking about the investments on the books of banks, but it was all in the context of bank earnings and how that was negatively impacting bank M&A. Not one speaker said, oh, and by the way, there may be a bank run and we may lose a $200 billion bank. So I think we need to be careful not to judge a board's action in hindsight based upon what is really clear now, right? So yeah. I think the concern for those on the call might be, though, now that we've identified the issues going forward, you know, you need to be cognizant of it. I know that's what we're going to talk about, but I'd really be careful here because this was an event that no one saw coming. I mean, I don't think the regulators saw it coming, and I don't think there's any harm in that. And saying that, frankly, no one saw this coming. They may have criticized them with regard to these securities portfolios, but I don't think they did it in the sense of your bank may fail, right? I don't think that was the message, because if that was the message, I think they would have been probably much more strong in their criticism and much more forward in pushing. So I hesitate. I know it's quick. Everybody wants to find a culprit. Everybody wants to blame someone here. I think there's a lot of blame to go around, frankly, in the context of what happened.
We also this was a bank run. I mean, no one survives a bank run, even the most well-capitalized banks. Anytime there's panic in the market and people pull their deposits, you have a problem. And that has very little to do with the solvency of the bank. It has to do with confidence in it. And that can happen to any bank, anytime, any place. It's all about confidence. And there was a rumor and there was a run, and that was the problem.
I might add a little bit on that, and I know we need to get on to other questions. And you're hearing the past regulator in me a little bit. Sorry, guys. But that's okay. I actually think it's good to have an ex-regulator on a larger bank board. I hope my fellow directors think that too, because we do look through at various issues through a different set of eyes. But the thing that really caught my attention when I first heard about Silicon Valley Bank was that it's a liquidity failure. It's not a capital failure, at least not initially. And the thing that was so interesting was the fact the bank grew well over 2 years, about 200%, 100% year over year, and no other bank was growing that fast. Now, we all had liquidity deposits from COVID funds, but not that many liquidity deposits. So it had such an unusual deposit structure. And I think that, combined with the choice of investments in long-term agency securities, is just something that is, regardless of how much interest rates move, it's an interesting strategy. So I just wanted to add that, because I do think this bank was just a little bit different than banks on this.
Julie, let me ask, because I think it's an interesting conversation. If this were a $300 million bank somewhere in America, and the regulators had concerns, I think they would have come down on them a lot harder than they came down on this $200+ billion bank. And that to me is a bit of a disconnect. It was almost like, okay, well, we told them there was an issue and they were supposed to do something about it. I mean, in my experience with smaller banks, if the regulators don't think you're hearing them, they call you back and say, you better hear us or life is going to become very unpleasant. And I'm not sure that happened here.
Well, and I think that's where Vice Chair Barr's report will be very interesting. Should it have been stronger? Should it have been faster? Matters requiring attention, matters requiring immediate attention are very, very important. It is not the same as the supervisory actions. So we'll have to wait to see on that one.
Mm-hmm. And what was interesting, by the way, on the signature, you had someone who would be identified, in at least the public's mind, is the ultimate regulator, former Congressman Frank. And there he was, and certainly there was no one who spoke louder in 2009, hence the Dodd-Frank Act that responded to this. And if he couldn't figure it out, did something he do? Was he inattentive, or not, or could he not understand it or not? But that's someone who would be viewed as having, at least in the public's eye, the ultimate expertise in the area, which suggests either there was no way to avoid it, Or, was there something that, will come out later on that we don't know about and we'll have to think about and examine? I don't know, but that's what's so extraordinary. The funny thing about the whole thing is when I teach corporations law, and we talk about the difference between companies, risk taking by directors and why equity holders like risk. And I said, well, the safest move is to just simply invest everything in U.S. Treasuries and all will be well. But investors don't invest in companies for that reason. They want the risk. I never thought there'd be a day when investing in my example is now out the window, because apparently investing in Treasuries is now a risky proposition, which I never thought was the case. But that being said, did anyone else on that board think the same way? And obviously you have interest rate fluctuations, but who could have foreseen the rapid increase, obviously due to the Fed's move? So there are a lot of actors here that have a part to play in this story, and who's really responsible, who isn't. It's going to take time to sort out, but maybe at some point with reflection, we'll understand it better.
I mean, I think and you guys have really touched on this. I mean, there's so much to pull from a risk governance, risk oversight perspective. Talking about, who expected 400, 500 basis point increase in interest rates. We've got an asset liability management risk problem, model risk. There were some assumptions baked in, and then apparently some back and forth with the executives not being pleased with those results. That's been alleged by the Washington Post, and I'm going to be very clear that's an allegation that's out there. We are still finding out how this plays out. Allegedly, SVB went a year without a chief risk officer, which I think brokers some questions as well. I mean, we're going to see kind of repercussions shake out of this. I mean, all of this kind of out there, what does that tell us about the board's role on risk or oversight? And is there a need for more scrutiny by boards in a higher risk environment where there's so much change going on?
Well,
Julie, I'm not sure. Yeah.
One thing, the compensation structure. I think there's a paper floating around, Sanjay Bhagat at the University of Colorado, who argues that bank executives should never be paid in options, but should be paid in long-term restricted stock that basically is restricted for some period after their exit. And the idea is to discourage excessive risk-taking, because they will have to hold on to the assets of the company. Sort of an interesting idea. I don't know how that plays out, but that's obviously something to think about. I mean, in other words, your incentive structures, have you designed those appropriately such that people don't take excessive risk? If you give everyone options or stock that they can sell as soon as they leave, that creates a greater risk taking, which is probably not something that you ought to be doing in the banking business. But again, these are long-term questions, and it's going to be interesting to see how they play out. Does your compensation structure have anything to do with a bank failure? And because you saw a lot of those questions come out in 2008, 2009. Again, if you can't see the out-of-control truck coming, would a different incentive structure have made any difference? In other words, there has to be some causation between the problem and what you could have done to prevent the problem. I mean, again, it's if you don't see it coming, how in the world are you going to prevent it? Like the risk officer, they had the risk officer there. Would the risk officer have made a difference? I don't know. It was a weakness, sure, and you should have one. But was that the cause of the problem? I don't know, and that's what we'll have to figure out.
Mm-hmm. Julie, you're our resident risk committee member. What do you have to add here?
Well, I guess I'm probably not as sympathetic to at least the Silicon Valley Bank situation, just because I see what we're doing at Simmons Bank, which is, a $26 billion bank, so small by comparison, and how much effort we have put into setting up a risk structure for a bank that small and one that we can grow into. The thing I would observe as being a member of the risk committee, though, is there are a couple things, and I hope this is beneficial for all the directors on the call. There are a couple of things that I think are important with a risk management program. One is, if it is strongly supported by the directors and senior officers, it will build culture in an organization. And boy, how many times do we talk about culture and not know what in the heck that means? But if this process of identifying risks, of surfacing them, of tagging them if they become important and reporting them to senior management and the board of direction is just an expectation of everyone's job in the bank. You have a very good culture. And so I do think it is important from the standpoint of what do you want over the longer term? You're not going to see all these problems coming at you, but someone in the bank is. And having a mechanism to be able to float that up and one that is respected and rewarded, I think is very, very important. The other thing is that I want to go back to the examiner's findings, the matters requiring attention and matters requiring immediate attention. And I know we have directors on this call from very small banks and to very large banks. But, you know, those are pretty dang important. And if they're not resolved, regardless of what they are, there will be a consequence. And maybe there should have been, at least in the case of Silicon Valley Bank. But as a board member, I would really, really encourage you to expect that if there are outstanding MRAs or MRAs, that you get regular reports on how they're being addressed, that you ask the question of why didn't we find these before the regulator, which is, again, is a great sign of an ineffective risk management program if you're not finding them yourselves. And then also, if you're just not sure that you're getting the answers that make sense to you, that you choose as a board to meet with regulators without the executives in place. Now, I know that can sound like it could create some tension with executives, but if an executive is unwilling or is unhappy with directors doing that, then I'd say there's another issue as well. So I hope some of those are just sort of practical pieces of what do you do with this? But, you know, if you get the warning signs, pay attention. You have a very important obligation as a bank director. And the warnings, if they come out, just take them into account and ask for responses and make sure it makes sense for you.
Really, I have two questions. Is there any evidence that the Silicon Valley Bank directors were aware of those deficiencies? And does the Fed communicate those deficiencies to directors, or go through management?
So I have no inside knowledge. I'll call that up front, but I did read Vice Chair for Supervision's bar testimony to the Senate Banking Committee. And there were three things he said that I took note of. One, he said the picture that has emerged shows that Silicon Valley Bank had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank. So back to that growth, because growth changes the risk posture of a bank, may change it, I shouldn't say it always does, but growth that rapid, in my experience as a regulator, is a very, very important red flag. The second thing he said is that near the end of 2021, so this is quite some time ago, bank supervisors found deficiencies in the bank's liquidity risk management, and there were 6 supervisory findings related to stress testing, contingency funding, and liquidity risk management. Well, obviously, nothing was done there because, normally when you have a liquidity issue, you look at your supplemental sources of liquidity, which tend to be Federal Home Loan Bank advances, broker deposits, market sources, Fed discount window, but you need collateral for all those. And if you have depreciated collateral, that can put you in a bind in trying to access those funds. And then finally, he noted in May of 2022, so again, that was a year ago, the supervisors had issued 3 findings related to ineffective board oversight, risk management weaknesses, and the bank's internal audit function. The message at least was delivered. Now, the question is, should it have been even more? I don't know. And of course, the other question is, where was the action on the part of the board? So I think we'll find out more when that final report is released.
Yeah, I attention to that. If you have to pay attention, as Julie said, I fully agree with that for the directors on the call. If there's a finding and the regulators want you to know about it, they will put it in matters requiring attention. You should read it. They'll typically go over it with the board in the exam exit meeting, and you should focus on it. I don't know what the facts are, so it's hard for me to speculate here. I do think there was a lot of blame to go around. I mean, think about how that occurred, how that run occurred, all the things that were happening with the investment banker and the press releases and the statements that were made that week. There's a lot that's going to be unpacked here. But I do think it's important. Not every bank is blessed with someone like Julie on the risk committee. And I think to me it's important for directors because I'm on 2 bank boards. They're smaller banks than the board Julie's on, but it's very important for directors to have a sense of what the developing issues are, both in the industry, in the macroeconomic environment, and be thinking about how could that impact my bank? How could that impact the bank whose board I'm serving on? And not just rely upon the financial reports you get from senior management, but think. And so that requires a director to do things like read Bank Director magazine, right? Read the American Banker, get a sense of what the developing issues are, and then think about how does that apply to my bank. So I encourage, whenever I talk to groups of directors, don't do this in isolation. Don't think of your bank as on this isolated island. Your bank is in this ocean of moving water, and things are coming around, and you have to kind of try to see what's going to happen, or at least create a conversation of what's going to happen. That to me is really important in any context, but particularly in this environment now. What should we now do next as a result of this occurrence?
And were the findings appropriately transmitted to the board? I mean, in other words, there can be findings, but the key is go to management. Does management report them to the board, or does the regulators themselves demand a meeting with the board to explain to them? I don't know what happened here. It'd be interesting to see if, in fact, regulators did inform the board and nothing was done about it. That's a real problem. But how was the information communicated? How seriously were the concerns communicated? I think that's an important, stepping back and understanding who's to blame here. That's, I think, part of it.
And Charles, I can offer from my experience as a regulator is the regulators would have met with the board of a bank this size. Absolutely. All boards have a closeout meeting from an examination, but a bank this size with this type of matters requiring attention, frankly, if it were a bank I had supervised in the St. Louis Fed District, I'd be at that board meeting and I would not be happy. So, and you guys have not been unhappy, but
I can imagine Julie unhappy. But Charles, I think, honestly, I think think of the lens, we're now looking back a month.
Right.
But think about where the industry's been for the last 13 years. It's all been on looking at the asset side of the balance sheet, right? It's all been about credit risk. It's all been about what lessons we learned from the Great Recession. There wasn't as much focus on the liability side of the balance sheet, and now there is. So I honestly think, the story hasn't come out here. I look forward to reading it someday. I look forward to reading whoever writes the definitive book on what happened at Silicon Valley Bank.
And can any no matter how strong liquidity is or backup is, survive a run? I think that's the other panic. It destroys everything. And was it the panic that did it, or was it the underlying liquidity of the bank that did it? And that's gonna be an interesting question too. When you have to run, everyone.
I'm going to blame it on the venture capital firms. Let's just put a stake in the ground here.
It's their fault.
Remember, after the savings and loan crisis, SNL regulators would expect savings and loans to know the composition of their depositors because, of course, back in that day, a little bit different. It wasn't mortgage-backed securities. It was mortgages during the savings and loan crisis, but same sort of liquidity issues occurred as well as, in those cases, depreciated actual mortgages. So, is it going to be a surprise if some banks that have maybe an unusual deposit structure are now expected to kind of know what comprises and what the risk is in their deposit structure? Seems pretty sensible to me. Now, I'm not talking about the bread and butter community banks. I think those deposits are likely pretty stable, probably more customers asking about insurance, and that's fine. There are ways to insure those deposits if that's important to a customer, but knowing the volatility may be something new if the deposit structure is unusual.
Do y'all think coming out of this that large companies will take out private deposit insurance? In other words, separate from the FDIC, because obviously $250,000 limit. And now they're going to insure everything, right? But can't do that for every deposit. Will large companies take out self-protection, if you will? Is that?
I don't think so, Charles. I think the last few weeks have been a real boon for IntraFi because I know that a lot of banks are saying to customers whose deposits they don't want to lose, hey, let us help you find insurance for all of that. But I don't see that occurring. Emily, where do you want us to go next?
Yeah. I think all this asked some questions around stress testing. I mean, I've had a lot of conversations lately that, hey, the test, to bring up your point, Jim, we were looking at asset side of the balance sheet. We were looking at credit. We weren't really looking at that liability side. And this has kind of exposed maybe a lack of imagination in some ways. And what came out of those conversations was, have we really been using stress tests? Have we really been putting, some rigor behind that? And are we really using that in the best way possible? And I'll throw this out, that community banks also do their own internal stress testing exercise. So we're not just talking about the CCAR Dodd-Frank stress test. But I mean, how can you think about, as a director, that you're preparing for the worst? Because that does require, in my view, some imagination to think about what the worst could be. I'm not sure who wants to pick that up. Julie, you may want to tackle that as the former regulator.
Yeah, so first of all, when you use the word stress testing, I think particularly for banker or directors without banking experience, that can feel a little overwhelming. And you can really get caught up in, oh my God, how do you understand whether these models are right and if they're picking up tail risks and da-da-da-da. So the way I like to think about it is, hey, step back from that and just use some common business assumptions. So first of all, what assumptions are being embedded? Take the modeling aside from it, but what are the key measures that are being put into the models that are meaningful? And do those measures line up with the business model of the bank? What I would expect to see in stress testing for a vanilla community bank is going to look a lot different than it might for a bank that is heavily dependent on private equity or startup deposits, because their risks are very different. Also, what other factors are out there that could change in any world? And interest rates definitely one. Yeah, they did go up fast, but you know what? It was over quite a long period of time. And so that's definitely one to keep in mind, but also the fact that we had so much liquidity through COVID. I know at the Simmons board, we often talked about, when's that liquidity going to leave? And yeah, it left fast when it left, but it wasn't a surprise because it was an unusual event for the bank, and it was something that we could be mindful of. And the other thing I would offer is, if for any of the directors on the call, and I'd say particularly for those in larger banks, if you're just not comfortable that the risk management and stress testing program of the bank are solid, have the risk committee or whatever your associated committee is commission an outside review. There's nothing wrong with that. And again, if you get sort of a worried look of concern on the part of the CEO, I'd be really worried about that. But having a third-party assessment as a director can be helpful in isolating those things that might be a little unusual or maybe very strong for the bank. And I would definitely say, do that if that's going to give you peace of mind.
When do regulatory structures become bureaucratic and sort of lose their effectiveness? That's always sort of a question I've thought. A la the Delaware law, the Caremark decision requires compliance structures, and Enron came after Caremark, which Enron had compliance structures in place. When do regulatory bodies become more bureaucratic and less, attuned to appropriate risk? In other words, I won't say check the box, but sort of a check the box sorry, because that's the only term I can think of. A check the box mentality that doesn't get at the underlying problem. And from a regulatory standpoint, is there ever concern within the regulators about the danger of bureaucratization of oversight?
I'll let you handle that one.
That's an interesting question. So I'm putting on my ex-regulator hat for everyone on the call. And gosh, I know culturally at the St. Louis Fed, that was the last thing we tried to do. We really viewed our job as being proactive, not check the box, reactive, heavyweight. That served no useful purpose. Now, if I put on my hat as a director, though, and particularly after what we have just seen with these liquidity issues, I'd say, it's for the community or smaller banks on the call. This is not just about the loan book. And I think for so long that had sort of been, that's the bread and butter of banking. No, there are many aspects to banking. And when regulators talk about stress testing, it's because they want you to think about those other aspects and what aspects may have consequences in multiple portfolios. I'm going to give you one example to bring that home. During the housing crisis, a bank failed. By the way, at the Fed, we did postmortems on these banks, and we built them into our examiner training so that the examiners coming up through the ranks, the new examiners could have the same knowledge as those that had been in the field during the time of the crisis. But we saw a bank that had a very, very heavy housing portfolio in its loan book, and it invested in mortgage-backed securities, in this case, private label, in its securities portfolio. Well, guess what? The combination or layering of the risk was the issue for that bank. And kind of back to, why do you want a risk management portfolio? It's so that you can see across those risks and bring them together in a way that's understandable. And importantly, if you do allow that risk to remain on the balance sheet, to capitalize for it appropriately.
Julie,
And I think it kind of goes to board composition, Emily, and I know that was something we were thinking about talking about. I think it's extremely important that as you're thinking about your board and as vacancies occur, as you decide to add more people to the board, that you think about, so what are our skill sets? What are our skill sets on this board? And it's hard, for a group of people to appropriately understand and measure risk when no one really understands the risk profile, right? I mean, because most people on bank boards are not bankers. I mean, they're not ex-regulators. I mean, they're business people. And the reason they're on the board is they represent the shareholder base and they represent the community. I think to Julie's point, it's important to take your cues when the regulators do send signals, and they don't always tell you what to do. They won't always say, do this. What they will say is, you may consider this, or we think this could be a problem. And that's usually their way of saying, pay attention to this, right? So, but you have to pay attention to it in the context of knowledge. And I think if you do not have that knowledge on your board, find it somewhere else. I mean, get a consultant. Maybe it's an accounting firm that you use, or maybe it's a law firm that you use, but find people that can explain to you in language you understand what the risk is and what the appropriate risk levels are. Why it's important to pay attention to concentrations in areas of lending. Why, now that you're looking at the liquidity side of the balance sheet, what is AOCI? Why does that impact? What kind of portfolios should you have? Because a lot of banks now, I think, are looking at each other and say, okay, what do we do with deposits? What do we do with deposits going forward? But if you don't understand the risk, I think I've seen a lot of boards that are just too heavily dependent upon the knowledge of management. And that can be a challenge if your only source of information is through their filter. So you kind of have to build, I think you have to build a complementary board with complementary skill sets, would be my suggestion.
Well, I think any board ought to have competent regulatory experience, any bank board today. I mean, I think that's a critical part of the equation. And frankly, if the board is there to oversee monitor management, part of the monitoring responsibility is how they deal with the regulators. And frankly, unless you've been a regulator or had significant exposure to the regulators, it's hard to ask those kinds of questions. I think that's every
Charles, I'm laughing a little bit because the Simmons directors that I know are on the call, congratulations for joining. I think it's great that everyone on the call made that choice to learn. But there have been times where we've had our closeout meetings with regulators, and as you say, Jim, there'll be, a broad-based recommendation made, and then after the regulators go, I'm able to say, now let me tell you what that really means. And right. So I think that has proven helpful. My other directors would probably say they only need one of me, but it is beneficial, I think, to be able to take that regulatory recommendation and put it in concrete terms.
It's asking the right questions, or when you get an answer, being able to evaluate the clarity of the answer itself. And it's hard unless you have, it's like the accounting. It's always been someone with accounting expertise on board. Accountants can present something to you. unless you really understand it, it's hard to simply rely on what they're saying. You have to be able to look back. You can't re-audit the company yourself, but you've got to be able to ask the right questions. I think clearly in a regulated business like banking, it's really critical to have someone there who understands it, either did it or had significant experience dealing with it.
What do the three of you, if you're looking at what makes a good board, essentially, because I think you could look at SVB's proxy statement and look at those resumes, and it looks like a large bank board. It looks like a public company board in a lot of ways. Their resumes look solid. It's a good board on paper, but what do the three of you think truly makes a good board?
Who do you want to start? You pick.
Jim, why don't you kick us off here?
No, sure. I mean, back to what I just said, I think complementary skill sets. I think that's extremely important. I mean, even if you have to use a matrix of skill sets, what does Julie have that Charles doesn't have, that Jim doesn't have? And how do we, because I think, you need financial expertise. It'd be helpful if you have regulatory expertise. You obviously need, you need insight into the business community. I think increasingly in large cities, particularly, you need diversity on your board. I tell board members, it's about business. It's about business because if your customer base is changing in its diversity, if your shareholder base is changing in its diversity, your board should be changing in its diversity. People ask me, when are we going to see even more diversity? I frankly think it's when we start getting that wave of female CEOs, which isn't that far away in banks. I think you're going to see significant change in diversity, but I've already seen a change in that. But to me, that's important from a business perspective. But to me, it's the complementary skill sets and then a chemistry. Some of the best boards I've seen just have kind of an indefinable chemistry. You can feel it in the room where, these people, they get along, but they're not afraid to challenge each other, and they're not afraid to challenge management. They can do it in a civil way. But there's just a sense of confidence, I find, in the best boards. There's a sense of, we know what we're doing, we're providing an oversight role, and frankly, you can sense when it's not there in a bank board. And Julie and Charles, I'm sure you've experienced that too.
Yeah, Jim, I'm kind of laughing here just a little bit because I totally get what you're saying. There is a synergy when you have different talents on the board, but a high level of respect among board members, and it's very effective. I do not hesitate to disagree with what other board members are saying, and they respect what I'm saying. And afterwards, we go out for cocktails, and it's a great time. So that is going to only occur if there is a great deal of thoughtfulness on the part of the CEO, because they're very influential in really digging into not just the backgrounds of the individual directors, but also how well they work together with others.
Real quick, let me just add on to that point for you. Julie just touched on this. In my mind, the single most important factor in an effective board is the CEO's outlook toward what they want in that board, because the CEO has, particularly if they're chair, has such an impact on composition of the board, preparing the agenda. So I just wanted to add that on. Sorry to interrupt you there, Charles.
I take a slightly different tack. I think that boards are pretty much the same regardless of the kind of corporation. You want independence on the board, independence of management. That creates objectivity. And you want strong equity ownership, because that links your interest with the interest of the company or the bank itself, as opposed to your personal interests or relationships with others on the board or the CEO. You kind of start with that. I also think you've got to find people with courage, the guts to speak out if they think there's something wrong, and not stay silent. But in addition to that, I think each board has to be constructed around the various areas that they're overseeing in management. If it's a consumer products company, you're going to have some marketing, you're going to have IT, logistics. If it's a bank, it's obviously people who have serious financial expertise on both sides of the bank. As a customer of the bank, or not a customer, because that compromises independence, but as a consumer of banking services on the corporate side, and certainly those who have expertise in understanding how a bank comes together and how it runs. In other words, you've got to have people who can ask the right questions, whether regulatory experience, capital markets experience, Those are all critical, and that's why the matrix is a very helpful thing. The key, though, ultimately, is once you're sitting there, is you want to be pleasant, but you want to sometimes ask the tough questions and not back down if you don't feel you're getting the right answers. And I think that's always been critical to any board makeup. But you have to respectfully dissent, if you will, respectfully challenge. But challenging is part of your job. And remember, too, you're there to protect the value of those who invest in the bank. That's your primary responsibility. But the only way to do that is protect the assets of the bank itself, a la your customers. So it really kind of folds. It's one of these things that kind of folds together. It's not, shareholders versus customers. No, it's all kind of one and the same, because unless you have customers, you're not going to have shareholders, obviously. But to me, and honestly, I would separate the chair. I think it's much healthier to have a separate independent chair of an institution, particularly a bank, as opposed to the manager. Because I think that the danger of the CEO picking the board is that they ultimately may develop relationships, or there may have been relationships that compromise objectivity. It doesn't make you a bad person. It just meant you view what they're saying a little differently. That was the Enron board's issue. I mean, Enron had on paper a very strong board, but as it came out later on, as the postmortems took place, there were all kinds of subterranean relationships that compromised the objectivity of the board, so that when the red flags were in front of them, they had no idea because they were comfortable with the recommendations or assertions of management. And in a standard board, without those relationships, you might have had more questioning. Whether that would have solved the whole thing, who knows? But it certainly wasn't present there. And I think the same thing in a bank. And the danger of having the chair as CEO, the chair does control the agenda of the meeting, which is a big deal, and does have impact on the appointment of other directors. I've always thought that really shouldn't be the management's role. The board itself, properly constructed, will find the appropriate people. Now, it can't be someone who, the CEO says this is the worst human being on earth. You can't do with that either. But you want them to take a distance from the process. And that's why I've always welcomed the separation of the two roles. And following the banking crisis, the last financial crisis, you had a lot of big banks separate. I thought that was a good idea. You've seen them recombine now. B of A is one that, had separated and then recombined it. I'm a shareholder of B of A, and I voted against that. I didn't think that was a good idea. I still don't think it's a good idea, because I think that to monitor effectively, you can't have the person being monitored chairing the group monitoring them. It dates back to historically when boards were really not products of shareholders, but products advisory to management. Why? Because shareholdings were very small years ago, and no one had enough stock in a company to give them the economic incentive to run for the board. And boards evolved to more advisory groups. Hence, they got a lot bigger. Banks were particularly noted for this, huge boards, customers, et cetera, et cetera, et cetera. And they really were more advisory than monitoring. That doesn't work. And I think that the separation of the two roles reflects the change in the composition of your shareholders and the change in the expectations of the board itself. The CEO is the person being hired and sometimes being let go. That's the board's responsibility. But having that person chairing it is not a good idea, which is, by the way, when a lot of these institutions we got in trouble, remember in 2008, it was interesting because the first thing that happened was the CEO was removed as chair of the board, which meant they were going to be leaving the CEO role pretty soon thereafter. In fact, that is what happened. But there was a recognition of the board that we can't do this anymore. And I think that that's a good lesson to come out of the whole thing. And I think it's a lesson that's kind of been lost a little bit in the last couple of years as we become more distant from that crisis. And I hope it's something that people will think about, directors will think about. There's nothing wrong. I mean, the idea of an independent lead director is good, but it doesn't get you there. It's kind of a non-exec chair light. You've got to be able to chair the board, has to control the agenda of the meeting and run the meeting itself. And when the person being monitored chairs the meeting, it really does change the dynamic pretty dramatically. And I've been on both kinds of boards, and I much prefer one that has the independent chair. I think it works if you get the right person really, really well. The other hand, the other is I don't think worked. It could have worked a lot better, put it that way.
All right, I wanted to bring this conversation, we've just got a few minutes left, but I did want to bring this conversation back to asking questions around risk, because I think we noted at the top, these were two very unique institutions SVB having its concentrations in we're going to serve the tech sector. Signature Bank was banking these crypto companies. So they had some very unique markers. But I don't think they're unique in taking advantage of we're going to build a niche in a riskier sector or some kind of new opportunity. We see banking as a service. We see a handful taking advantage of that. Not trying to equate that, but offering that up as an example. So I'm curious how boards get comfortable with maybe banking some kind of emerging opportunity or taking advantage of some kind of opportunity, while also keeping their eyes wide open about what those risks are when it's kind of something evolving and it's complex. Julie, I'm not sure if you maybe want to get us started there.
Yeah, so, banking as a service, I'm going to just set that aside a little bit. That's so big that you'd almost have to say in exactly what dimension, because some are riskier than others. But, my staff at the St. Louis Fed and I would have this discussion about the banks. I called them monoline. That's not exactly right. But they concentrated in a business, whatever it was, and whether that the bank could adequately manage the risk. And over the years, what I really came to appreciate is the smaller the bank, the harder it was. And the reason was, if there was a mistake and you have a small bank, you may have a high capital ratio, but you may not have much capital in absolute dollars. So if you're going to go down that path, boy, you better have some level of expertise that is super, super, super above and beyond, because there's just not a lot of room for error. And sometimes some activities are best done in larger banks just because there's an absolute volume of capital there. I think too, as a director, if you are in a bank that's in a niche business, your obligation to understand the risk has just gone up way, way high. Not that it's easy sometimes to fully understand all the risks in a community bank, but they're proven over multiple economic cycles. And so we tend to have at least some sense of how they might ebb and flow. If you are going down the path of a bank that has a niche business, you've got to be able to think about what the consequences might be in changing environments. Economic one is obviously the one that stands out. But, just as we learned with Silicon Valley Bank, how social media behaves and those sorts of things, what reputation risk might mean. So I don't know if that answers all the questions, other than to say, personally, I'd be anxious being on the board of a bank that was in a niche business, simply because I'm not sure I could fully appreciate the risks. And for me, it's important to serve on a bank board where I really do understand the risks.
The bank has to be, businesses have to grow. They have to innovate. You can't do things always the same way you've always done things. I shouldn't talk because I use a fountain pen, but but it was a famous banker in Atlanta, from Atlanta, years ago, named Mills Lane, who was very innovative and somewhat controversial. But he came up with the idea of, after the war, auto loans. And no one was making auto loans. Who thought of it? It was a brilliant idea, and the bank did very well with them. And obviously, manufacturers did too, GMAC and everything else. But, that was innovative. And in, 1940, whatever, who would have thought of lending people money to buy an automobile? It was actually a great boon because it enabled people to buy cars who couldn't traditionally buy cars, didn't have the money. And it was a boon to the automobile industry. It was a boon to the economy. It was a boon to everyone. That was risk. Now, I'm sure back then some people said, Lyndon, on an automobile? Are you nuts? But it was a risk we're taking. That's why people invest with you. They invest to take risk. Banks can't be too risky, but they can't be completely risk averse either. Otherwise, no one's going to invest. So how do you strike that balance? And that goes back to your board. The board has to be innovative enough to say, that's an interesting idea. Let's try it. But careful enough to say, we're not going to bet the bank on it, so to speak. And that's where judgment comes in. A la directors. That's your job, is to be judgment. So, it's worth thinking about, but we're not going to bet the farm. Let's see where we go. But if someone had said no, there might never have been an automobile loan in this country. And what would we have looked like at that point before there were home mortgages? Did many people own homes? I think that's the key. Think about it.
And Charles,
Yeah, I would be concerned though if one of the lessons. I understand everything Julie's saying, but if you think about some of the most successful banks over the last 5 to 10 years have been niche-oriented banks, and so I think for those directors that are on niche-oriented banks out there that are listening to us, I think if you listen carefully to what Julie said, you really need to understand that industry. You really need to understand the risk so that you can appropriately oversee management. Because I do continue to think that some of the most profitable, growth-oriented banks in the U.S. right now are niche-oriented banks. They bank dentists. They fill in the industry, right? They're focused on that, but you really have to understand it. You have to understand the risk, and you have to see that coming. The other thing, though, that I think is really important coming out of this is there was clearly an assumption that the venture capital funds in Silicon Valley Bank were core deposits. There was clearly an assumption. There was clearly an assumption at Signature Bank that the 20% of deposits that were related to digital assets were core deposits. And it turned out that in neither case were they core deposits. And I think Signature is it's like this is a bank that was diversified, that did a lot of commercial real estate, but 20% of deposits were tied up in the digital space. And apparently there wasn't much of a connection to the bank other than those deposits. It wasn't like these people were getting loans. So I think that's one thing coming out of this is let's step back and say, okay, what are our core deposits? Because those are the deposits you really need to be able to count on in the long run. And to me, that really probably hasn't gotten enough press coming out of this. That's something that you really need to be focused on right now, I think, as a bank board.
Yeah, that was a good clarification. Charles, I would also say this, the term you used I liked a lot, which is don't bet the bank on it. There is a difference between taking on risk in a thoughtful way with good controls over the risk and allowing that risk to season over time as you allow it to grow. That's a very thoughtful approach to taking on risk. Then there's the grow the bank for the hell of growing the bank because you can. That is not a considered thoughtful way to take on risk, in my opinion. So how you do it matters. And again, I will say as a director, you need to understand the basics of it to just simply see that there are out of whack opportunities or businesses in the bank and not understand what it means is just simply putting yourself at risk. And the final thing I'll mention is, remember, if you go back to the origins of enterprise risk management, it was really the idea of how much capital do you have to be able to take on the risk that is there. So understanding the risk is pretty darn important to know how much capital you need.
Well, Julie, thank you for that thought. And I think we're going to have to close it out with that thought because time has flown. So I want to thank you all, Julie, Charles, and Jem, for joining me today. This was a fantastic conversation. Appreciate you being here. And I want to thank everyone who's attended this webinar. And as a reminder, you will get an email. If you'd like to revisit this broadcast later, you will have that. But for now, we're going to sign off and enjoy your afternoon. Thank you, everyone.
Thank you.
Thank you, Emily.
Thank you.
Take care.